How did we come this far? We've gone from a very low point in March 2009 to an exemplary level of gains. With one quick glance, we understand how we got here. But who is there to predict what will happen when they reverse course? The conditions we're about to face are resting solely in the hands of the central bankers. They will decide your fate. You came here for the truth, so let me unveil that for you. I'm completely reinvigorated by the comments, the positivity that I received in the last video. Let's get into this hard-hitting, jam-packed episode today. Chart of the week. What's next for buybacks? That is the topic of today. Buybacks, buybacks, buybacks. They're going crazy in 2018 with the amount of buybacks, keeping this market afloat. Corporate client buybacks by week of the year. You can see that right here in this chart. It might be a little difficult to see depending on the screen you're looking at, but essentially, I'll just quickly make the note that we are engaging in more buybacks than ever before. I'm not going to get into the details of every week here and make you fall asleep, but just understand that that's happening today. The question is, who exactly are buying these stocks? In what sector? What's happening? What are the details? Here, first half, sector flows. Clients' net buys of U.S. equities by sector in the first half of 2018. Well, I have done videos previously about this issue, broken down exactly which companies are doing the buybacks, and interconnected with that is this. Tech shares. Huge increase in the amount of buybacks. Financials, massively. And I want to note something. The blue area is corporate buybacks. The yellow is single stocks excluding buybacks. These are in the negative territory for tech, financial, healthcare, and so on. But I want to focus on especially in the tech sector. Think about that. What has happened to the NASDAQ 100? The NASDAQ 100, the tech stocks, actually, if you look at it, it's trading within a range. And I've showed you that. So we've seen this range going on now for several months. You can take a look at stocks like Amazon, for example. They've basically been heading upward. You see the FANG Plus stocks, yes, they are heading upward. But even the NASDAQ itself, so if we focus on tech stocks, actually they're not doing very good at this time. And understand who's actually pushing up the stocks. Corporate buybacks are the number one reason in 2018 why these stocks are either rising or staying around this range. The reason they have not come down is because you have massive intervention, corporate buybacks, as well as the QE. Now, the QE is starting to change. We are seeing the tightening take place. But think about this. With financials being down 20%, from their peak at one point. I think they've come up a little bit since. But at one point down 20%, yet we've had incredible levels of corporate buybacks. It's still not enough. Still not enough to keep it afloat. Imagine the amount of real money that's been flowing out. People are selling off right now because they're worried. Look at the smart money index and how that works, and this is dropping down. Ever since late January, the smart money index is dropping down quite a bit and quite consistently. In fact, people are moving their money out. Buybacks are coming in to help this out. Now, there's always stock buybacks. You're going to see that in good times and bad times. There's no doubt about it, but not at this level. It is historically insane, to say the least. So this tells me what's happening, that's going on in the first half of 2018. It's going to continue on in the second half of 2018. The question is, will those selling off outweigh the corporate buybacks? Or will we see continued quantitative easing making its way into the US stock market? Or is quantitative tightening going to be the new thing for 2018? That's all remains to be seen, and of course I will cover it here. Very quickly, 3 charts in one: hedge funds, net buys, institutional clients, and private clients. So we're seeing here the hedge funds, it might be a little hard to see on your screen, but hedge funds down, okay, in the negative territory right now. This just now retreated to becoming net sellers for institutional clients, and private clients just barely, because they're insignificant, in the positive territory. All right. Most of the money is leaving. Most of the money is leaving. Remember what I'm telling you here. You look at all the shares of the market, they peaked out, so they're coming up in 2017. It's going crazy. It peaks up out at that late January moment. We have the VIX index. Everything comes down. All right. So markets around the world start dropping. Then we see stocks like Amazon, like Microsoft, like all of these companies, and they start to rise, okay? Some of them surpassed their previous highs. Okay, so I want to focus on a couple sectors. So I look at tech. Tech is doing much better than financials, for example. It's doing much better than, let's say, China's stock market. I could focus on other markets around the world, other sectors, okay? But I want to focus on the one that supposedly is doing well. The supposedly is doing well. Keep hearing it. And I look at the NASDAQ 100, okay? The NASDAQ 100, and I see it trading in a range. It's still at the same level it was months and months and months ago. So we have quantitative easing, trillions of dollars. We've got big individuals out there like Warren Buffett buying up billions of some of these companies. We have all of the corporate buybacks. We have every reason for these stocks to come up, and it's still trading within a range. This is not healthy. I'm just pointing it out. Doesn't matter what you own or what anybody else owns. I'm just pointing out the facts. Rife with anxiety, markets are churning at the fastest rate since 2008. One of the hallmark of this bull run, complacency, has made way for angst. Okay, so let's just cover this very quickly. I'm going to show you some charts along with this. From junk bonds to emerging market stocks, market turnover is through the roof, reaching multi-year highs. Within the S&P 500 index, investors traded more than $2.9 trillion worth of shares in each of the past 2 quarters, a feat last achieved. Guess why? In early 2008. Nobody likes to hear that date. They start getting scared and they start getting defensive. Burgeoning uncertainty from monetary policy and protectionism to cracks in the synchronized growth story, good wording, has spurred elevated trading across assets. 3-month churn, S&P 500 turnover exceeds $2.9 trillion for the first time in a decade. Look at the way this has happened over these years. Connected in with this, creeping toward panic levels. Turnover the highest since the emerging market crisis of the late 1990s. So surpassing even what we saw during the financial crisis. See where this has come throughout those years leading up to the financial crisis, making the exact same pattern today. And oh, don't worry about it, because everything is going to be just fine this time around. They have control over it. They didn't for some reason in 2008. They didn't in 2000. They didn't every previous time. But this time though, this time is different. Sure. ETF fear indicator, elevated trading in broad market funds signal investor anxiety. You can see that on the right hand side. They've highlighted it for you. Taking a look at this, I see that anxiety clearly taking place whether or not this chart means anything to me, it doesn't really make a difference. All I'm trying to show you is that through all these different waves, the market is not healthy. The economy is not healthy. And that's really, really frightening because they've done so much to intervene in it. I want to switch gears here for just a couple minutes before I end the video. Fire-ravaged San Francisco home once labeled a drug den sells for $2 million. Okay, so you can see this home. I'm sure the neighborhood is very nice, actually. I'm not familiar with all of the different areas of San Francisco. However, it might be okay, it might be great, the neighbors might be great, the community might be great. All I know is that when you have a drug den selling for $2 million, you have a bubble. It's just the way it is, okay? Maybe they're going to completely tear the house down, start from scratch. I don't know what they're planning on doing, okay? But I just know that you have a burnt down house and it sells for an incredibly high level. There's this disconnect in between reality and whatever the hell else that's going on. All right. And then this, residents of New York City's, quote, Billionaires Row have filed a lawsuit in a bid to block a 150-person homeless shelter from opening in their neighborhood. So you have these record-priced homes, $100 million and so on, and they're trying to build more housing that is able to basically shelter a lot of individuals. And this here is a growing problem. Billionaires on one side, millionaires on this side, and a whole bunch of other people. And slowly but surely, we are witnessing the disappearance of the middle class. More and more people are falling underneath the poverty line, and those actually above the poverty line are oftentimes statistically above the poverty line, but actually unable to make ends meet. I've shown you that here on the channel before. Didn't see it anywhere else. Nobody likes to cover that type of information. And so we have this, as far as I'm concerned, a big issue that's not being addressed, okay? The real issues are underneath all of the data, and you dig through it and you connect the dots. That's the most important thing. People are they're just thinking they're gonna wake up tomorrow and they're gonna say, okay, it's a recession, we admit it finally. They didn't admit it was a recession until several months after the recession took place. Then they said the recession was over far after, far before, I should say, it actually ended, based on their statistics even. Of course, there's many reasons to believe it's still on today. It's still the continuation happening. Anyway, it doesn't matter. I'm just saying, don't expect them to come out and say it, and then you're going to say it. Because when you start saying it, I'm going to be on the opposite side of that bet. If you found this video informative, please give me a thumbs up. When you give me a thumbs up, it helps to support this channel, so I do appreciate that very much. We need to look at what's going on with people's mentality, the average person out there, the financial media. Usually, in most cases, I would say 95% of the time, the opposite is true. That's what I found in my research and my studies. Now, if you want the financial education that was not taught to you in schools, you need to check out these two books. These two books have it all. All right, so look through the books at Amazon. Links are in the description of this video. If you're more interested in the audiobook version, you can get that at themoneygps.com.